All right, so let's kick off this next section on supplier finance programs. And maybe, Mike, first you can just tell us a little bit about what are these things?
Well, basically, supplier finance programs are a case where a big company, so when we have a case study in a minute, but like Walmart, let's say, will enter into an arrangement with a bank. And in our case, it's JP Morgan. And basically, JP Morgan and Walmart decide what they're going to do is the suppliers. So, Walmart has bought goods or
Mm-hmm.
services from suppliers. Instead of paying the suppliers, Walmart pays JP Morgan Chase
Okay.
at a much later date than they pay the suppliers. So
Mm-hmm.
that's kind of what we're dealing with here. And these arrangements are really spiking up. I mean, I think
I
I
was going
have
to say,
some.
why are we talking about this
Yeah.
today?
Well, we're talking about it because there's a new ASU,
Okay.
hence the reason why it's a GAAP update. But basically, what is this? U.S. transactions are estimated in this area
Mm-hmm.
are estimated to be about $300 billion. And PwC did a survey, and they said that 49% of the companies reported they use these type of
Okay.
programs, and 37% basically are considering their use. So you add those two together, what's that, 80 something percent? This is a big thing kind of
Pervasive issue.
happening. Yeah.
Okay. Okay. And so I see what's in it maybe for the Walmarts of the world, but what's in it for the other parties? Why are.
Okay, so what's really happening here is you have a so the Walmart. What happens is, let's say they were normally paying Gap Dynamics. We did some training for Walmart. We didn't, but if you're listening, Walmart, I
We would
love
love
to
the
do some train.
opportunity.
Love to do some training, and don't screw me on the supplier financing. But we'll talk about that in a minute. But basically, Walmart has, let's say, entered some training for Gap Dynamics, and they owe us, 10 grand, and our terms say 210 net 30 or whatever. They normally pay this in 25 days, 30 days, or whatever. Well, first thing that happens is Walmart again enters this arrangement with
Mm-hmm.
JP Morgan Chase, and they basically say, okay, we want to pay our invoices in 60 days or 90 days. And so what they do then is they come to me, Walmart, and says, we have this new great thing for you. And that is now you can get your money even faster. And I'm like, well, I'm fine with 25 days. And they're like, no, 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 no. 25 days, not for you anymore. The new terms are 90. And it's sort of like I remember this. I had one of our largest accounting firm clients. I won't name names, but I remember back in the Great Recession.
Mm-hmm.
And she came to me and she said, Mike, there are two types of vendors that work for this company. One, those that lower their prices, and those that don't work for us. And I looked at her and I said, is there a third option? And she said, no. So I think that's what Walmart's doing. They're Walmart negotiating these vendors to take less days. And what they'll say is the benefit to me is instead of waiting 90 days for Walmart to pay me, I can get my money as soon as 5 days from JP Morgan.
Okay. What's the catch?
Well, I ain't getting the full
Ah.
amount, right? I mean, I'm getting 95 cents on the dollar or something like that. So the win for JP Morgan is they get, they get fees from Walmart and fees for the handling of the transaction. For Walmart, they now get to pay JP Morgan later.
Mm-hmm.
And for me, the supposed gain is that I get my money quicker, other than 90 days, which now Walmart has renegotiated with me.
Okay. Okay. Great. All right. I think let's look at an example and see
Yeah,
how this
let's look at
plays
that
out.
Walmart example and see what happens.